All right, so the end of American exceptionalism, that chatter seems to be quieting down right now. In fact, I was kind of shocked when I saw this report. Norway says they actually have no plans to reduce their U.S. assets. I want to bring in now David Kelly, Chief Global Strategist at JPMorgan Asset Management. And, you know, David, in many ways, the Bloomberg article referenced this. America coming out of this Iran conflict seen in a stronger position. Now, we know things like nat gas and those kind of things give us a sort of an edge. But what do you make of it that there was a lot of fear in the last month about how badly America would be impacted by this?
Well, I think the first thing is that we haven't seen as big a spike in energy prices as perhaps people thought. I mean, yes, we've got oil prices, bumping over $100 a barrel, but in fact, in real terms, this is not as bad as we saw in 2022. It's certainly not as bad as we saw in 2008, and we're a net oil exporter. So it's, yes, the American consumer gets hit, but the American oil producer or energy producers are helped. So I think that's one part of it. But the other part of it is we've got this huge flood of money going into equity markets, through 401k plans, stock buybacks, just through the sheer income of the richest people in America, and it's just pouring into markets month after month, week after week. And I think it means you've got to have a very negative story, a very scary story, to truly cause this market to collapse.
I've been saying for years, maybe it's derogatory, but I keep saying the fix is in because of that. I mean, every week people get paid. Their money automatically goes into the market, focuses on the biggest names. The biggest names drive the market up. It's just a fortuitous cycle.
Absolutely. I mean, over time, the advent of stock buybacks, going from defined benefit plans to defined contribution plans, which all go into the equity market, or almost all, and then capital gains tax, which means it's so hard to sell. I mean, how sure are you that you want to write a check to Uncle Sam right now? Those things are always, they're all, in some sense, yes, they're fixing the game to push money into the market, make it hard to get money out. And I think that's why the market is so resilient.
Let's talk about your bumpy road to a sub 2% economy. We know the war is winding down. It's still sensitive. Moments ago, President Trump was speaking on Fox, and the air came out of the rally, at one point. Then he made some comments that suggested, hey, you know what, the ceasefire could be extended, or negotiations could be extended, and we're rallying back. So that part, maybe we can start to put in the rearview mirror?
Well, I think the thing is, it's not a matter of what happens next, it's how it's going to end. I think in the end, these negotiations are going to split the nuclear issue, which is very thorny and difficult to negotiate, and the Hormuz issue. And basically, if the Strait of Hormuz opens up and everybody else can get their oil out and Iran can get their oil out, then there's a win-win there. And that's where I think they're going to come to an agreement on that within the next few weeks. And when they do that, I think that's really what the markets are betting on, that at some stage it's too expensive for the West to keep the Strait of Hormuz closed, and they're just going to have to concede something to Iran to get that open again. And from the financial markets, they don't care about the politics of this. That will help bring down inflation. It's one of the reasons why I think inflation and growth could be less than 2% in 2027.
That's amazing. So then where does that frees up the Fed? I mean, by the way, this is what we've heard. Scott Bessent has been kind of saying this over and over again. I think Hassett was out this week, maybe today, this morning, saying almost the same thing, although they acknowledge near-term inflationary pressure. Yeah,
I mean, I think that if the Fed needed to cut rates, I think it would have an excuse to do so in 2027. Personally, I don't want them to. The problems the American economy faces, and they do, it's a K-shaped economy. I think that it's very unaffordable to buy new houses and so forth. That's really not going to be fixed by the Fed cutting rates, because all you're going to do is cause a further bubble in home prices. Right. So the problems the economy faces it's not really going to be fixable by lower rates. So I'd rather they leave rates kind of where they are.
Are we between a rock and a hard place then on Fed policy? Because I hear what you're saying with respect to more money, priming the pump and making inflation more difficult. But by the same token, when they hike rates, I don't see how that does anything for people. If you look at what's the most expensive out there, from college education to medical insurance to car insurance, none of that changes. So if the Fed takes my credit card rate from 16% to 22%, I still got to pay these exorbitant insurance fees.
Yeah, I'm not saying they should raise rates.
No, I'm just asking you from a philosophical point of view. How do we ever find a way to thread that needle?
Yeah, I think the thing is that for the economy, rates are almost a wash. Because if you raise rates, you actually give more income to people who are saving money, and that's a big issue in this economy. But you also, push it up for borrowers. But for financial markets, higher rates do slow down financial markets. Lower rates cause a boom. So it would be good for financial markets, except that's only going to make the K-shaped economy worse.
Well, financial markets don't necessarily care, but that's also why Warren Buffett was able to put $400 billion on the side, because he was getting paid pretty good to not do anything.
Well, yeah.
So then, before I let you go, because we're running out of time, where do you see our markets for the rest of the year?
I think our markets can still go up for the rest of the year. I mean, unless some shock hits it. But I would, we were talking beforehand, year to date, S&P 500 gives you a 3% total return. MSCI ACWI ex-US is 9% so far this year. And this is the second year in a row. So, just spread it out a bit, because you could get a shock. And when you do have a shock, you don't want to be in the most exuberant market. And the US is certainly the most exuberant market in the world.
It feels like we may revert back to the trade that was working, to your point, international, maybe small over mid, maybe value over growth.
Just spread it around. I mean, people have made a lot of money. Let's hold on to it.
All right, David, great stuff.
Thank you.
All right. Folks, coming up, quantum, photonics, the stuff that's making people bazillionaires every other day. Well, we got a couple of best of the stock pickers out there, including one who's got the hottest hand I know. The good news, they've got some new opportunities. We'll be right back.